Today, I see how awesome life can be. Beauty all the way, power to shape my day. Thoughts become real. One with all is what I choose to feel.
Good morning. I'm Mary with Suffolk Headquarters,
now,
and with me today is Rosemary Ashley, a mortgage originator and more, with multiple years experience. And today we're going to be talking about mortgage processing. Good morning, Rosemary. It's good to have
Morning,
you with
Mary. Thanks for having me here.
us. Okay, so today we've already, done all the things we needed to do. We found a house, we put in an offer, the offer was accepted, and now what's our next steps?
Our next step, I think that we talked about inspection last time. We take the house through all the different contingencies. The first contingency generally is the inspection. So when the buyer hires an independent inspector, goes in and looks at the house, gives them basically, I think we talked about that a little, an idea of what we're going to need to do in the future. So once all the contingencies are released, sometimes there's renegotiation, sometimes not. But when the inspection contingency is released, that's when the actual mortgage processing begins. Generally, the customers get the mortgage application, they sign the documents, they lock the interest rate or they float the interest rate, which we talked about last time. During the after the purchase agreement is accepted, before the inspection passes, so that once the inspection clears, the mortgage team starts ordering the appraisal and the title work and all the background checks, about seeing if the person owns any other property or if they have any outstanding liens anywhere that didn't show up on the credit report, and their job history and the detailed credit report, and all those things happen. So that's when the mortgage representative generally sets up the computer for everything that needs to happen for that particular house, using the property taxes as they would need to use for that specific house, and a good idea of homeowners insurance. Then what the loan officer does is sends the loan to the processing department. The processing department actually orders all those things or oversees all of the gathering of all the documents that are required to make this approved. And that's when they'll generally send it in for initial underwriting. And that's when the actual decision maker will issue a mortgage commitment, initial mortgage commitment, a conditional mortgage commitment. A lot of lenders do that as soon as they get the purchase agreements, so that we can give the people the commitment and let them know the list of things that they need. So all of those things are going on. And then the customers are, I tell people that buying a house is like a part-time job, because all you have to do to keep up with all of the mortgage requirements and all of the real estate requirements, I mean, from looking at a house to, knowing what's going on and keeping apprised of everything, it takes a lot of time. And time is of the essence. So where during pre-approval, it's like, go ahead, when do you think you're going to get me the paperwork so I can see if you're going to be, approved for this loan? To, I need the paperwork today. Now, sometimes I need it right away, depending on the time constraints of the actual purchase agreement. And generally, we do everything up front, and then we wait for everything to come back in. And so that process generally takes 2 weeks, but it could be more. One thing that really determines how long it takes to process a loan is the customer. So if the customer is able to provide the documentation required in the format required, let me talk about that for a minute. if you have a bank statement and the last page is intentionally blank, we need that. If you have something on the back of your driver's license, like a change of address, we're going to need that. And a lot of times when customers give paperwork, I mean, even in the modern age, I mean, we can do it with PDFs and emails and uploads, and still have faxes, but they come on my email. That's still quite a job. I mean, if you have your documents electronically, you like your bank statements, that's easy enough to send over a PDF, but sometimes it gets more difficult, like you got paper statements. The underwriters are not going to look at every individual page of an 18-page retirement account. Well, they will, but they're not going to be happy about it, and it's going to be more difficult to review everything and keep everything together. So what I like to do is get it all together. Every page of a multi-page document has to be included. Sometimes people like to take pictures with their phone, which is good for a W-2 or your picture ID. They're one-page documents. That's absolutely fine, because if you take a good picture, you can see it, but everything has to be legible. The pages can't be cut off. You have to be able to see the numbers. You have to be able to see the URL on the bottom of a lot of the pages when you're doing things online. It has to be in a correct format. So sometimes the correct format, or an acceptable format for a loan officer for a pre-approval, is not necessarily what the underwriter is going to look. For example, your retirement account. If you've got a retirement account, you've been at the company for 6 years, you've got regular contributions, and all I see is the final page that says this is your balance minus your loans, and here's your vesting. That is good enough for me to know they have an account and they have money from it. All the other pages, the underwriter's going to require. So that's when we make sure everything is in its order. So that's kind of like, in a nutshell. Then when the documents come back, that's a different story. You'll have, for example, an appraisal. Mortgage underwriters are required to make sure that all of the little details and the verbiage is in the correct spot. Sometimes they have to answer to the underwriter, well, why did you use a comparable house that's 4 miles away? Well, I mean, it needs to be explained. In some cases, that's acceptable. Or why did you use the comparable from a longer period of time? And that may be acceptable, but the underwriter is the final decision maker on the value of the house. So people often think that once the appraisal comes in, they're good. I don't have any problem, but that's always up for underwriting review. And one deal I closed last week, we had some back and forth with the underwriter he gave us a list of, and I didn't read the details because generally the processor handles that unless she has trouble or a problem or needs something from the borrower. Then she contacts me, but she puts everything in the file. The underwriter looks at it, and there was the same conditions for the appraisal. And I don't really remember what they were, but it had to be in there. Otherwise, we don't have a legitimate appraisal that we can use to sell on the secondary market and get our money for the loan, get the servicing released premiums. So title work is another one of those things. Title work comes in. Now there might be liens on the property, which is the seller needs to cover, pay those before they close. There might be some kind of defects. I had title work on another deal I closed recently that it was on a condo. So we had to get a litigation letter from the condo association, which is standard practice, about that there's no outstanding litigation that can harm the association, which in turn harms the homeowners. And I guess we went back and forth with it. Because there was some lien or some litigation that was accepted on the title work. There was an exception. We're going to cover the lender and guarantee them, the first lien on this title, except for this item here. It's listed on the exception with some litigation. And the underwriter wasn't going to give up on it because that could make a significant difference. And that underwriter spelled it out for that. We want to make sure, our borrowers are not liable for whatever this was. And the title company in that case, well, that legislation's from 1997 or that litigation, 1997. It was resolved then. And I'm like, so she goes, I can just remove it from the title work because we were looking for documentation that proves. I'll just take it off the title exceptions. I'm like, yes, please. Yes, please. Because if it's on the exception and something happens, then the lender is still on the hook for their lien position. So that's, and generally when these things come in, the processors these days aren't generally trained to review them, because that's the underwriter's job. I mean, the underwriter's job is to review all those little details. And, sometimes it's kind of tempting to be an underwriter, to think about, I could be an underwriter. But then I have to think about just looking at paperwork and number crunching and guidelines, which I do before I originate a loan or while I'm originating. But to do that all day, every day, and not be able to pick up the phone and talk to the customer, like, what was that? What happened here? You can't do that when you're under. Everything's got to be black and white. You've got to see it on the paper. And basically, you have to cover your assets to make sure you're following the rules. Otherwise, we could be held liable for that loan. It could bounce back to us. We would not be able to sell it. That would be a bad thing for mortgage companies.
Absolutely. As you were talking about the timing requirements and people having, documents available like right now, immediately, it's a good thing, again, to go through a checklist, that we talked about. I think it was in week 3, where you have all your documents ready. And, so there's very little, oh gosh, I don't have this and I got to go searching for it and whatnot,
Yeah.
because then again, you delay things, and timing is really important a lot of times.
Yeah, timing is important because, well, aside from you have a purchase agreement expiration date,
Mhm.
and everybody gets nervous when you can't make it. I mean, it doesn't matter what the reason is. They want to close, they want to close, they want to close. Right. We want to close, but we also need to make sure we have first lien position. So we're working with the title company to get that exception removed. It doesn't matter what it is. We need all of our I's dotted and T's crossed. And,
Mhm.
in general, it's an invasive process.
Right. Well, I
mean,
know in the purchase agreement, you also put in a closing date, and that is kind of a, this is, we will close by date,
on or before.
and so, a lot of times those closing dates come real close, and the title company's still working on stuff. The underwriter's still working on stuff, and you're getting within 2 or 3 days of that closing, and people are starting to sweat.
Well, and there's a lot of reasons why purchase agreement expiration dates are not met. I think one of my favorite ones personally is when you have 30 days on a purchase agreement and you have a loan program that's not likely to close in 30 days.
Now, what loan programs, kind of go into that a little bit, if you would?
Sure. Well, one loan program I was thinking about recently was it's a program through the state of Michigan that gives people, you can have down payment assistance up to $10,000 or $10,000 down payment assistance on the house. It's income, family size and income dependent and sale price dependent. But last year in November, I had one that needed to go to the state. It's called MISHDA, the state of Michigan, for review, but the state of Michigan had a 2-week turn time. I mean, it was like 2 weeks. And in November we had Veterans Day, Thanksgiving Day, and the day after off. And you're thinking that's only 3 days, but that's 3 business days. And that, they don't come back to work and do all the stuff they should have done before or was supposed to be out. That you couldn't rush them. They didn't allow rushes. So then you have to wait for that 2 weeks before you even get reviewed. So when the listing agent called me, she said, "Can you close this in 30 days?" I'm like, not likely, because there's things I don't have control over, which is the state agency that I can't rush.
Mhm.
So we don't have control over everything. Another circumstances where the lender won't have control is when they're sending it to another lender, when they're brokering the transaction. A lot of lenders do that, mortgage bankers, correspondents. They set up a portfolio of lots of different lenders to basically get whatever programs are out there. I mean, whether or not you use bank statements to justify your income, or you use a profit and loss, or you use the latest fad is a loan that when you're buying an investment property, depending on what the market value of the rent is, it has to be self-sustained, and you qualify because you've got the rent already covered. So there's a lot of creative ways, different kinds of loans for different kinds of scenarios, and they all have added set of requirements. Maybe not so much documentation, but different kind of documentation.
Mhm.
And those are generally sent out to the ultimate, to the lender, as opposed to, so some mortgage companies are mortgage bankers, like a bank, and a bank, they have their own money, they have their own investments generally. But if you're on a correspondent, a mortgage broker that corresponds with lenders and has in-house underwriting ability, for example, it's called delegated underwriting. They can underwrite, they can make the decisions on the loans that they're from the companies they're corresponding with. They make the decisions and they can close the paper. Everything's done in-house in my employer, my direct employer, for example. And then there are some circumstances, like when you're brokering a loan, you have the bank who's doing the processing and doing the underwriting. So that's also things that can take additional time. And everything, the purchase agreements need to be extended, or there can be a whole host of issues. And a lot of times, the sellers don't want to extend the purchase agreement because, they're worried about, is it gonna close? So I put this on and I hold off marketing another week or 2 weeks or whatever. And what if I'm losing out? And what if this doesn't close? Or what if there's a better offer out there? So it gets everybody's minds thinking about what if. I had a situation last year where they had accepted the purchase agreement before the customer was pre-qualified. And so they accepted the offer, and I hadn't even said we're good to go yet. And in this particular case, sometimes I can look at W-2s and pay stubs and like, okay, you're good. But in this case, I couldn't, because of the time on the job and the way we had to calculate the income and the time off work. No, this was something I needed an underwriter to make a decision, because it's the underwriter's discretion
Mhm.
If it's the underwriter's discretion, I don't get to say. I can say, well, I would approve it in this circumstance, but I'm not the underwriter. And that's not my job, does not rest on this decision. So sometimes the underwriter says, yes, we'll do this, but we don't do this, back and forth. So in that case, it was a 30-day purchase agreement. Customer wasn't pre-qualified yet. I needed paperwork from outside source. In this case was the employer. And the employer didn't really have a HR department that did that. So I got it when the manager got to it, and he was already working 12, 14-hour days. So there was that time lag. And I told everybody, they said, are you going to close by close date? I'm like, I don't think so. And this is what we're waiting for. And on the day of the expiration at 8 o'clock at night, the listing agent, she wasn't really communicating a lot, with me. Except if there was a problem. Are we going to close it? We got to close it. We got to close it. We got to close it this day, or the seller's not going to extend the purchase. I'm like, well, I just need a couple more days. And we're just working on compliance issues, dotting all the I's, crossing all the T's. All the borrowers already been approved, all the mortgage commitments done. Well, I don't know, the listing agent, I think, felt a little weird because she hadn't made sure the customers were pre-approved or pre-qualified. And it would be egg on her face if that was a dead deal. She'd be having a very unhappy seller, obviously, because she didn't require a pre-approval letter to accept the deal. So yeah, the listing agent was all nervous. The buyer, she's like, just do what you need to do, Rosemary, just do what you need to do. I think the listing agent gave the sellers my number. They called me at 8 o'clock at night on the day of the purchase agreement, or 8 or 9. And I missed it. I called back a few minutes later, and the lady was really mad. She said, I don't think it's going to close. This is why I'm not going to extend the purchase agreement. I said, whoa, wait a minute. I think this is going to close. I'm pretty sure this is going to close. And the only things that we have outstanding are little nitpicky details that we have to do before we can get it scheduled to close. That was another condo. I don't remember the details on that one. And
Was
so
the listing agent representing the buyer as well?
no, there was a buyer's agent, and I was in constant communication with the buyer's agent, and he was in communication with listing agent. But and the seller should not be calling the lender. That's inappropriate from a real estate side, because whatever the lender said can affect how the seller thinks about it. So, I mean, in this case, I guess it didn't even matter because the seller said she wasn't going to extend the purchase agreement. And I just said, no, wait a minute. These people already have a mortgage commitment. They're conditioned on some compliance issues that I can't go into details with the outside parties. But I could tell her that the customers already had the mortgage commitment, and all of the conditions regarding the customer's income and assets and credit were already handled. She said, well, how long do you need? I said, give me to the end of the week. And that was a Monday, and we closed on Friday.
Yeah,
And
well, we
everybody
did
was happy.
that with the house that we sold. Is we extended it from Monday to Friday, just because there was a glitch when they gotten the mortgage commitment. There was a debt that wasn't listed, and so then
That
they
always
had
happens.
they had to pay off a debt before they could close, and they had to come up with a $12,000.
And prove where you got it from. Yeah, exactly. And that's not always easy. You mentioned that there was a debt and it didn't show up. I'm working for a pre-approval this week, and they have inquiries on your credit report. Anytime your credit report is checked for the hard pull, it shows up as an inquiry. One of the underwriter's jobs is to have the customer document those inquiries. Did this result in a new loan? Is it on the credit report? Is it not on the credit report? So that's one of the things some lenders, especially at a pre-approval status, they neglect to review. So they look at the credit report, 745, I'm good, credit score, right? Oh, I'm good. And then they import the data into their software, their processing software, and then it lists the debts, and it poof. And then of course the computer determines your qualifying ratio, so you don't have to get out the calculator every time, but there's some problems with that too. And depending on your loan officer, processors don't do it anymore. It used to be in the old days, processors would review all that paperwork. And I mean, they wouldn't be the final say, but they would give the loan officers a heads up. Hey, you've got a large deposit on such and such a date and such a bank account. I think the underwriter's going to require that explained. You want to get it ahead of time? Yeah. But, you know, when I was new, that's what processors did. And I learned so much about the rules. I mean, it's not just the book. Well, the book is online now, but we had an actual book back then. It's not just the book. It's all those little details inside underneath that you don't necessarily see. So if your loan officer is doing pre-approvals, especially these days where competition is really tough and people are getting pre-approved at multiple places. And what they don't understand is when you get pre-approved at multiple places, you're having a bunch of people work and only one of them's going to get paid. So what ends up happening, it's just like a snowball effect. So the business changes, and now, you know, the government recommends that the customers shop. But here's the thing, they shop, but they can only shop when they get a loan estimate, because what they say on the phone is not valid. So you really get a loan estimate when you have a property. So when you have a property, if you've got 3 or 4 pre-approvals going, yeah, okay, send me a loan estimate and I'll decide which one to do. Then, you know, you got 4 pre-approvals, you got 3 lenders that are not going to get paid. So, and we're talking about the loan officers and then the actual company. The company has to pay their processors and everything like that. So what I have seen happen is, like, in the beginning of my career, what they did was pre-qualified customers, right? You talk to them on the phone, yeah, they're good to go. And then we stepped it up and we said, okay, now we're going to get your W-2s and your pay stubs and your bank statements. And we're going to pull in, you know, an initial credit report. So those elevated to doing more work, because these realtors count on us. They hand us our paycheck. Here's a paycheck of mine that I'm expecting. I need you to make sure I get to the closing. And they want to know right up front if it's going to get to the closing or not. So the pre-qualifications morphed into pre-approvals and all the documentation, sent it to underwriter. And then what happened? You know, so more work, more time, more solid pre-approvals. And then what started happening is, you know, where it used to be 1 out of 2 pre-approvals would actually close, it got 1 out of 4. And I don't really know the numbers, I'm just guessing. But what it seems like now is lenders have to do a lot more work to get the same amount of closings out. And a lot more work is a lot more paychecks. You know, people need to get paid, a lot more processes, a lot. So now I've noticed it's kind of gone on a downswing for my competitors. They will have the customers apply online, you know, so you'll have people telemarketing, get the customers to apply online. And telemarketing is a big thing, and advertising are a big thing. It's they get a lot of the business. It's not so much personal referrals anymore, because people say, well, I don't need your help. I can get pre-approved by myself. Why do I want to ask for help? I can do it. Go online. But what they don't understand is the information is only as good. The pre-approval is only as good as the information, number one. So, you know, I've had customers give me, you make, let's see, $12 a month. I'm thinking that they put the wrong information in, right? That's not right. So I'll call the customer, say, well, you said you made $12 a month. Oh, no, I'm 12,000. Okay. I can change that. So the pre-approvals a lot of times are automated. and they don't involve a whole lot of highly qualified people's times. And they've kind of slacked on the pre-approvals. It's gone through the cycle, and now it's down to the slack because they don't want to spend a lot of money up front if they're not going to get paid. If you do a verification of employment, that could cost $150. Credit report can cost $100. If you've got two unmarried people, couple hundred. Got two unmarried people, they got 2 jobs each in the last 2 years. That's a lot of money. Background checks. And I don't really get into details on that. But even above and beyond the appraisal, I mean, if you have a condominium, there's condominium documents, questionnaires, letters. They have to deal with the homeowners association. So, I mean, there's a lot of little details that need to come in. And the best you can do, and because the loyalty is like, okay, somebody's got an 1/8 better interest rate, they must be better, but they might not be, depending on their costs and fees. And it takes an educated eye to be able to look at that and compare loan estimates. So the government laws that were designed to protect people basically add extra layers that customers want to get the best deal, but they don't really know what the best deal is. I mean, it's a complicated product. There's a lot of different products available. So what is the best deal? Points and fees and this and that and the other thing and rate. And then you get into the timing. Is it going to close on time? Are we going to have somebody who's effectively communicating? Because I'll tell you, the loan officer makes a difference whether or not, or can make a difference whether or not the deal will be extended. The communication with a loan officer can make the difference between whether or not it's even going to be, the purchase agreement's going to be accepted. So what ends up happening is one thing happens. Okay, now you got to shop for more rates, or now we got online advertising. You don't have to ask your mom about her experience with lenders. So I'll get it myself. So now you don't have any personal relationships. You have automated. It's called transactional relationships. I get you because I'm spending money on advertising. I get you because I got people, I'm buying leads and calling telemarketing people. That's transactional. And what that means to the buyer is they might be nice, they might be smart, they might be, make you feel good, but their primary concern is that specific transaction, as opposed to the relationship you have with them. And there's a difference.
Yes, there is. There's a big difference.
I got a call, text, email. One of my customers, a lot of my customers are Facebook friends now. And this customer lost her husband last year. And, of course, it's a devastating thing. So she's posting some stuff on Facebook, and, I'm sending my thoughts and actually some of the words from some of the songs I make in my free time. And then she hit me up on text and she said, "Thank you very much for that. I'm wondering if you know of a good handyman, somebody that comes with some recommendations, somebody personally." And, like my mom's got one. She's got one that she uses. Let me see if she's willing to give out his name. So I still work with these customers, giving them information that they need in order to, anything about the mortgage or any about resources, because I'm in networking groups. So you've got that person that you can call and ask questions. This is Rosemarie, I got an escrow analysis. I am what? Yes, send it over to me. We'll go over it. It's called after the sale service because it's the relationship that's important to me. I want your loan. I want your loan to close, but I also want you to refer me to your parents like you personally did, or your kids, or your siblings, or your friends, and the people that you work with. I want my customers to be so pleased that they worked with me that they tell other people. It's called word of mouth advertising. It's called relationship-based sales. Relationship-based sales is really the best way to make that goal of because that kind of sales. It can replace the home. It can replace the relationship by having my customers.
Right. And that's
So
a
it's
good point.
moving that way.
It's a really good point because, there's so many companies out there now that are talking about we need to develop relationships with our clients, build the trust. And, this is something that is people want, and it is lacking in this transactional marketplace. And
And it is because of money.
yeah,
The companies don't want to pay for human expertise. So it started, well, what I remember with the
Well,
auto workers.
we're running out of time.
Okay.
For this one, we'll take a break.